Hi, welcome to the Fall 2025 It's Your Money and It's Your Estate workshop series, brought to you by our 501c3 nonprofit organization, Financial and Estate Literacy. Our mission is to empower you to take control of your finances, your estate, and your charitable giving decisions. For the past 25 years, our founder, Peter Kote, as well as our entire team, have been providing these free, unbiased, and accessible 6-week workshops all over Orange County, California, as well as online, to help you make informed decisions that align with your unique needs and values. Let's start the program. This webinar is the 6th and last session of the It's Your Money workshop series. The topic for today is Smart Financial Planning, Part 2. Our moderator is Peter Kote, and our guest speaker is Laura Tarbox. Enjoy the workshop.
Welcome to Financial and Estate Literacy. We're a not-for-profit with our mission and our purpose is to provide a safe environment to learn about money, about estate planning and charitable planning. And we're on our 6th week, and we're privileged to have our guest speaker, our presenter, Laura Tarbox. Laura, why don't you come on board? Good morning.
Morning.
And Laura, we're not going to, your Ask First form is on our website. And so let's just talk a little bit about your background. Uh, we are very privileged to have you as a volunteer presenter. You're nationally known. You have taught the CFP courses. You have been in the practice in the forefront of fee-only financial planning, and you're located right here in Orange County.
Yep.
And you are going to be presenting in person at the Orange County Library next week on Monday.
Yes.
Talk a little bit about your firm and how you got started into this area.
So, yes, I started out in the early 1980s on what we call the dark side, on the sales side of the business, which was really the only way at that time. It was just starting to be another option available for fee-only advisors. But then it was all sales and literally in my early days, knocking on doors and making cold calls to sell mutual funds for commission or to sell insurance or annuities. And I love the financial world, and financial planning was really starting to take off then. But the product sales side just didn't make sense. That just didn't go together with giving people good advice. So I dropped all my licenses and kind of went cold turkey, fee only, in the late 80s, right around 1990. So kind of early in that trend. And I remember thinking that, of course, everybody is going to be practicing that way, within a decade. And that's a long time ago, and it hasn't happened because there's just so much more money on the dark side, and it's very different when you're not selling products and you're actually, trying to do the best thing for your client. It's a very different approach. I think it attracts different kind of people on different sides of the business, because there are a lot of options that make it much easier for an advisor to practice in that, truly fiduciary manner. So I've got a team of 9 people here in Newport Beach. We do very comprehensive financial planning, tax planning, estate planning for our clients, manage a little over $1 billion for around 100 families.
Yeah. And how do you charge your clients?
So usually a percentage of the assets that we're managing, sometimes flat fee when we're doing more of accounting, family office type services.
And what is that?
The family office services?
No, they
Or, oh,
both.
so our fees range from 0.35% to 0.85% of the assets that we manage, and the flat fees can be, 5,000, 10,000, 100,000, depending on what we're
Yeah.
doing.
Well, you've managed family wealth offices, so you've handled multi-million, in the billions. And so you've been in the practice of financial planning for how many years?
It's the 40th anniversary of my firm this year that I started my firm. So a couple
40
years more
years.
than that, actually.
Yeah. And so what you
Through a
have
lot of market
done
cycles.
in you have a very unique practice. What you have done is limit your number of clients, but you have increased the minimum type of client. So talk a little bit about that. What is your minimum today?
So our minimum is 5 million of liquid assets that we manage.
And sometimes people think, well, gosh, I don't have that much money. Why is this presentation then worthwhile to me? I'm going to let you answer that.
Yeah, I mean, we all advisors work a little differently. I think, I go to a lot of presentations, webinars, seminars, and if you pick up a couple good points, I think it's worth it. Also, I really do feel like we're kind of a family here with this group. There is, as I say, surprisingly still not that many advisors who work on a truly fee-only basis, not selling you anything, truly independent. And we all know each other, and I'm always happy to provide referrals if somebody's not a good fit for us. And I always will offer for people to email me, tell me about your situation, and I'll give you a couple names that I feel are good, but it's the same names that Pete or Don are going to give you probably also because
Well,
a small circle.
is the process any different for somebody that has a $500,000 investable assets versus $10 million investable assets? The
You know,
process.
the process isn't the same, and the challenges are actually most of the challenges are the same, and and having a lot of assets doesn't always go with having a lot of sophistication and experience investing. So there's a lot to learn, and it's the industry is very complex, and I think a lot of financial services providers out there don't try to make it easier to understand. They try to make it more complex and to make you think that they're the experts and you need them. But I
Yeah.
think, finding a good advisor who can clearly explain things and make it simple um, is important.
If anyone watching this wishes to contact you, is there a charge for that?
No.
No. So if they wanted to give your office a call for some guidance or a referral, they don't have the minimum 5 million, you would be able to help them.
Yes.
Okay, great.
Yes. And
Uh,
on my whole team's on board and can, pretty much anybody who answers the phone here could help, but I'm also available, and email is a great way to reach me.
yeah. Uh, Today's session is called Financial Planning 2. So we're going to go through some of this process that we've been talking about. And so I am going to kind of disappear and going to let you take over. I'm going to be listening and I will be answering questions in the chat and that type of thing. And I'll come back in for clarification if I think it's needed. So, Laura, why don't you go ahead and bring up your outline and let's get started.
Great. Thanks, Pete. Um, yeah, and feel free to pop in. I know you had a couple articles that you had possibly wanted to share too. So
Yeah.
pop in anytime. Does everybody see this?
Yes, we can see it.
All righty, let's go. So this is financial planning part 2. So a little bit of a wrap up, trying to summarize and touch on a lot of things that you've learned the last few weeks if you've been attending all the sessions. Um, you know, we feel strongly that most people will benefit from working with a good advisor. There've been many studies showing that working with an advisor can increase your investment returns because left to your own devices, you're very likely to do the wrong things at the wrong time. Vanguard has a well-known study that an advisor adds, 1.5 to 2% in annual returns based on just some behavioral coaching that an advisor can provide. But fee only is super important. I think the most important thing in an advisor is finding someone who is practicing in the right ecosystem. There's so much conflict of interest in our business on the banking and brokerage side. There are, good advisors there, but it's not a good system. Advisors who aren't trying to sell you anything, who aren't trying to meet their quotas. All those firms, all the banks and brokerage firms, they have certain minimum production that the advisors have to meet to be able to stay there and advance in their career. So it's a very different system than a truly independent fee-only firm. I think the term fiduciary has gotten so muddied, however. When acting as a fiduciary, you are required to act in your client's best interests, not your own. And yet there are many firms out there now, we find, that are calling themselves fiduciaries when they are not. And this is especially something we see with firms that may have unaffiliated with the big brokerage firms, set up their own shop, but then they're still selling insurance products. And they'll say they're fee only or fee based, and they may say they're fiduciary. We were talking before we started here, Pete and Don and I, and there are radio ads I hear on KNX News when I'm driving to work, 2 or 3 RIA firms, registered investment advisor firms, that say they're fiduciaries, and I've kind of figured anyone advertising on the radio, I don't know that I've ever known of a fiduciary advisor who advertises on the radio. So I checked these websites of these firms, and sure enough, they are connected with insurance companies or even broker dealers, and they're still saying they're fiduciaries. So I would say you're not likely to find your good advisor on a radio ad or at a free dinner. These people are selling you products, and they're high cost products that you often cannot get out of easily.
So one of the first things that you want to know is that how are you paid? Are you receiving any? Let me ask you, Laura, are you receiving any monies from any other source besides the client?
No. And,
Say,
and that's one way to ask it, which shows up, I think, on the ask first form. Who
yes.
pays you? But the brokers have learned to twist those words. They may sell you a mutual fund and say that you're not paying it. The mutual fund's paying me. Well, that's still not how you want that to.
So can I be assured that if somebody is a CFP, that they will not sell me anything?
No, most CFPs are licensed to sell stuff. I'm sad to say, many of them are fee only, but many of them aren't. And CFPs can work for insurance companies, banks, brokerage firms by themselves. It's just an educational and licensing credential. And it means that you've met certain standards, and you have a lot of disclosure standards that you can apply and still follow the rules while you're selling stuff when you're a CFP. So you want fee only and a CFP ideally. For financial planning, that's the credential. That's approximately a 2-year program that goes deep into all these areas that we've covered the last several weeks in these sessions: insurance, estate planning, retirement planning, cash flow planning, education planning, all of that. So
Yeah.
certified financial planners have deep training in financial planning knowledge, but they may still be selling you stuff. So you need to use that ask first form is a great way to screen an advisor. It's so simple, really easy to fill out, and it will, it'll show if they have any licenses. So having a bunch of licenses is a negative, not a positive. And I think people get confused by that. Securities license, insurance license, all those means that they're probably going to be trying to sell you things. So
Before we go to the next slide, Don, could you bring up a recent article that was in the Investment News, which is a industry publication, and it kind of breaks out.
Laura, stop sharing.
Okay.
Thank you.
And I just want to get your comment on some of the the language that they use in the article. As you know, Wells Fargo advisors 7 years ago opened up accounts for individuals unbeknownst to the individual. And this was over 1 million accounts were set up. And they were under immense pressure to sell products from the tellers to the managers to the brokerage firm. And so there was an article in the investment news as to what their fee structure was going to be in 2026. Can you scroll down here? It says, according to, if you look in the third paragraph, it says, according to the summary, advisors will continue to operate under a $13,500 monthly production hurdle with a 50% payout on revenue above that threshold. What does that mean, Laura?
That means that they have to meet certain production quotas of sales. It could be annuities, insurance products. It could be managed accounts that you buy into their packaged accounts. It could be banking. I think that could be banking services under this wing. It could be opening checking and savings accounts, selling you a mortgage. It's a very different thing. These are terms that that firms like mine don't typically use. Our people are paid a salary here. They're not paid based on anything the clients do or don't do. They're paid on giving good service to clients and bonus for that. There's no production requirements at firms like mine typically.
Yeah, they even the firm also is increasing credits for annuity business and boosting payouts on multiple generation accounts, provided they are tied to anchor households of at least 5 million in assets. What does that tell you? What are they trying to do here?
They're trying to they're trying to earn money on every little bit of you that they can, and they're looking for larger and larger clients as all advisors are.
So they also here on the above paragraph, they said advisors, and by the way, they call them advisors. They don't call them salespeople. And they say now they're going to get a recurring trail payout on checking account balances. So if you are with a Wells Fargo advisor and they refer you to get you to open up a checking account, they what is that? 15 basis points and 25 basis points if they are linked to a personal credit line. So if you borrow money, what does that trail payout mean?
That means that they're getting paid on your account every month. If you have a loan with Wells Fargo, a business line, a loan, it's just
Even if you have a simple checking account?
apparently so. Yes. Yep.
Um,
And that's, just one of the things that if you're working with a good advisor who's on your side and not on the side of the bank or the brokerage firm, like if a client of ours needs a loan or they need a margin loan, we negotiate to lower that rate. We're not getting anything on it. We want them to get the lowest rate. So if you work with, yeah.
yeah. So Wells Fargo advisor, Wells Fargo as a company was fined $3 billion by FINRA for their shenanigans. Nobody went to jail. Uh, Over 1 million customers got really taken. And so when you look at $3 billion, you go, gosh, that's a heck of a lot of penalty. They must have learned. Well, take a look at this. Just in 1 quarter, the bank turned a profit. By the way, people in Wells Fargo do not get paid low salaries. So this is after all of expenses. They turned a profit in 1 quarter for $5.59 billion. So a $3 billion fine is practically nothing.
Yeah, it's baked in. They understand that that's likely to happen, and they're going to continue doing what they are doing. Sometimes there's a settlement where they change it up a little bit, but they keep doing it. And I
Yeah.
mentioned earlier, we all work. Most independent advisors work with someone like Charles Schwab or Fidelity as our outside custodian, but they're not they're not pure either. They're doing this on the retail side and trying to raise money. And what Schwab got in trouble for recently was making it very hard to move your money out of the cash sweep accounts, which paid nothing. When money market funds were paying over 4%, Schwab's cash, sweep was 0.1%, and they got sued and fined many billions of dollars, but they were making so much because overall everybody keeps a little bit in cash. They had so many billions that they were making on that money. They're out investing it and getting 4 or 5%, and they're paying you nothing. But they decided it was worth the penalty. It was worth the fine. They just said it openly on an analyst call that they're going to keep doing it because it's worth the penalties.
Yeah. And
So you really need someone who's an advocate in your court looking out for you to try to avoid all of these people who are trying to get money from you.
Yeah. Just, and by the way, this article just came out about a week ago. So this is very recent. And Wells Fargo Advisors is one of the best, the most consumer friendly today because of their they had a cap on how much they can borrow. Anyway, why don't we bring Laura? Why don't you bring back up your outline and let's go to this your second page of that.
Yep. Sorry. So just one last thing is to do check on the website, and you can see what
Check
trouble
FINRA,
an
broker
advisor
check.
on the broker check to see what trouble the advisor you may be considering has gotten into, any black marks on their record, any disciplinary actions are disclosed there. And the brokerage firms work hard to erase those as much as they can and get them settled. So if you find somebody who has one or two or a few of those issues, that I think that's a problem. You definitely want to think twice about that. And talk to more than one advisor, because everybody has a different approach. Everybody has a different investment philosophy. I'm sure you've seen a little bit of that here. But I think that's important. You need someone you're comfortable with. You can't, it doesn't work very well if you're going to keep secrets from your advisor, for example, if you don't quite trust them. So you need someone you can trust, and someone whose philosophy makes sense to you. So usually people are seeking out an advisor if they're having a life change, something, they're about to retire, or somebody's passed away, or they have a goal that they're trying to figure out how to fund. Making sure your money's going to last your whole life, that's kind of an important one. And that's one of those things that is the same, really, no matter how much in assets you have. People who have a lot of assets can still outspend their money. And we've seen that happen, which is pretty crazy. So the rules are the same, really, no matter how much you have. And the process for how you approach financial planning is very similar. So minimizing taxes, I think almost everybody, that should be part of everyone's list of goals. And there's always so many changes in the tax law. You really got to take advantage of what you can, because it seems like there's less and less of that available. Not a lot you can do, but there is some good planning that will make a difference. And we'll talk about some specific ideas on that a little bit farther on. Deciding on the best Social Security claiming strategy. If you haven't started Social Security yet, there are different ways to approach that, about when you should file if you're married, when the spouses should file. There's a few things you can do there, not as many as you used to be able to, but that's important. Maybe buying a vacation home, that's something that could be a goal that you want to figure out how that fits into your overall plan and your spending. Helping out family members, evaluating your insurance needs, getting your estate in order. We've had some pretty significant changes in the estate tax law with that $15 million exemption going online in January. So estate planning is going to change for a lot of people. It may become a little bit easier. Gifting to your favorite charities, there are more tax efficient ways of doing that than others, and that's an important goal. So how all these goals fit together is something that a good financial advisor will be able to help you with as part of the financial planning process. So the very first thing that we like to do is to get a snapshot of somebody's whole situation. And we do that by creating a financial statement or a balance sheet, which will show your assets, your liabilities, the cost basis, what you paid for something, and then any additions to that basis, because that helps us look at whether you could sell that asset without a lot of gain or not. How are your assets titled? If you have a living trust, are the assets titled to the trust that should be in the trust? Doesn't really help if you have a trust set up and then you don't fund those assets to the trust. We still see that happening occasionally. I think that that's one of the things a good advisor will really help clean up any loose ends. Are your beneficiaries correct? Are they as they should be on your assets? That's important. Reviewing your cash flow and spending. This doesn't mean, we're putting you on a budget, but you really should have a good idea of what you're spending. That's a lot of people don't have a good idea of that. We can usually look at a few documents and a tax return and get a pretty good handle on that. But I think that's important to look at how you're spending now, how that spending may change in the future as you age, and then factor that into what is your what amount do you need to save to be able to retire if you aren't retired, or if you're retired, how much are you going to be able to spend throughout your lifetime and not risk running out. So the cash flow, what your expenses are and how much coming in and out, super important. Reviewing insurance policies, that's something a good advisor should be able to do. Everything from property casualty to any life insurance policies. It's a lot of people have been canceled by their homeowners insurance companies the last couple of years, and the market's crazy. And one of the things that again a good advisor will be sourcing resources and good referral sources. That's something we spend a lot of time doing. We vet all of the people we refer to. We've found some good property casualty carriers some work in different areas, some work with different types of properties. But that's something that we've worked hard to find resources on, as many of our clients lost their longtime coverage in the last couple of years. Life insurance is something interesting that most people are sold some life insurance at some point, and then they don't really look at it or think about it a lot. And your life insurance policies need to be managed and overseen also, depending on what kind they are. But there's, you could be at risk of losing your policy if it's underfunded. You might not really need the policy anymore. One of the interesting things that's happening in the marketplace is there are now really good options for selling an insurance policy. That's called a viatical, or viaticating the policy, where you basically sell it to someone who is going to hold that and then someday collect a death benefit on it, but they'll pay you much more than your cash value in the policy. And we've seen some really good outcomes for people who didn't need their insurance anymore and were maybe thinking of cashing it in for the cash value. I mean, just to give you an example, we had a client with $1.5 million policy. He was, I think, 80. He was needing to put a little bit of money in each year. I think there was 200,000-ish in the policy, and he sold it for over 400,000 to a company. It used to be kind of weird because individuals would buy those policies. You don't want somebody else owning a policy on you and wanting you not to be here. That's just a little creepy. That was a little weird. But now there's large companies that pool all these type policies together, and it's very much anonymous. It's not like there's one person owning this policy on your life. But those are some good resources, and that is a tricky industry also. The companies that do those kind of settlements will typically charge, the brokers will charge maybe up to 35% of what they're going to get back. And we actually found a resource who charges 15%. So you get a much better payout if anybody ever is in that situation. Reviewing a tax return. Your advisor should always have a copy of your tax return each year. There are possible planning opportunities that we can spot there that you might not be taking advantage of. We want to know what tax bracket you're in. that affects how we manage the investments, whether we recommend a Roth IRA conversion, what we might do with as far as charitable gifting. I mean, the tax return's super important. And, you know, a lot of the CPAs out there don't do a whole lot of planning ahead with the taxes, and the financial advisor could work hand in hand very well with a CPA in reviewing some options for tax planning together and kind of nudge that process along, which is what we find we end up doing sometimes. So as far as the insurance, as I mentioned, homeowners, life insurance, also medical insurance, there aren't, for individuals who are still working and don't have coverage through work, that's somewhat rare, but certainly that exists. There aren't a lot of options, but there you do need help through that situation. You're much better off working with, in my experience, a broker than going direct to some of the websites to try to figure it out yourself. The Medicare, for those on Medicare, we recommend that you have a good agent to work with. You don't pay any more going through an agent, and a good agent can really give you some good information and advice. They should be checking with you every year to see if there's a better option given your health situation, any medications, and so on. So we've found that our Medicare person that we refer to has just been a great resource for our clients. Disability insurance, if you're still working, that's something that can be really important if you have that through your employer. That's a great benefit. Long-term care insurance, I think you had a whole session on that, so won't go into that. Did want to mention earthquake insurance. I'm a big believer in earthquake insurance. I'm convinced that we're way overdue for the big one. And for most people, it's not too expensive. It's very area specific. So sometimes it just seems like a huge premium, but for most people, it's not. The premiums actually came down for earthquake insurance because we haven't had one. There's more money in the CEA, the California Earthquake Association pool. But you know, most people have so much of their net worth tied up in their house that I think that's something you want to spend money on protecting. Bundling your policies for coordinating the claims and discounts is important. If you have everything with one carrier, you can often save a lot of money. I don't see that I have umbrella liability on here, which is, oh, yes, I do. The last one, umbrella liability insurance. If you own a home, you should have an umbrella liability policy. You know, they can be $1 million, $3 million, $5 million. The umbrella will pick up where your other carried insurance levels tap out. On your auto, if you're insured up to 500,000 on a car accident, the umbrella would sit on top of that and maybe provide you another couple million of coverage. Very inexpensive to buy umbrella insurance, maybe $300 or $400 for 3 to 5 million of coverage. That's annual premium, because people don't end up tapping into them too often, and they're usually used primarily for the cost of the legal defense in some kind of a lawsuit. Very few people end up getting any of these huge payouts that we sometimes hear about on the news, but it's a lot of peace of mind for a small amount of premium to have that umbrella liability policy. And consider higher deductibles to lower your premiums. On your car, you don't want a low deductible because you don't want to put in claims for relatively small amount that hurts your record. And carriers are much quicker to drop people even after you've been a loyal customer for decades. We've sure seen that with some of the big carriers in California. Tax planning, super integral to any financial planning. As I said, any decisions that you're making, we want to see how that's going to affect you tax-wise. So there's tax bracket planning, where you might have some choices about how you take income. You might have some choices about how you take gains or losses in a portfolio that may affect your Medicare and the IRMA tax, for example. There's lots of tax bracket planning that we can do where we want to take income up to a certain bracket if we can, and keep you out of the next higher bracket. On the investment portfolio, a good advisor is not just going to be trading your portfolio on a machine without looking at your, I mean, many do, but without looking at your particular situation, how this is going to affect you tax-wise. And, can this person, we're always looking, oh, they could take a little more gain, or they have some loss here, we can offset it. So every change that we make, we're taking into account individual tax circumstances. That's something I think to ask an advisor too. Are they really looking at your situation? One sign is if you're moving from one advisor to another and you ask them, are you going to sell everything when the account moves to you? And if the answer is yes, that is, unless it's in an IRA and there's no tax consequences, that's not a great sign. A new advisor should be looking at all the holdings and factoring in taxes before making any changes. I know we go back to clients in the beginning and we talk about the transition plan, and sometimes it'll take 2 or 3 years to get things where we want, because we don't want to take too much in gains in any particular year. Batching your itemized deductions, the SALT tax cap was raised again in California for most people earning under, all but the top brackets. But there's a lot of planning to do around that and ways to work around it with the pass-through entity tax. We've seen several accountants miss some of those planning opportunities for clients. Always good to have a second set of eyes on your tax returns. Batching charitable contributions. So we love donor advised funds. We'll talk about that toward the end, but that's a great way to kind of really maximize your tax planning around your charitable contributions. And most people should not be giving cash. If you're making any kind of a substantial contribution, you should gift appreciated assets, appreciated stocks in your portfolio, for example, rather than giving cash, and then you're getting double the benefit of making that contribution. Qualified charitable distributions are great. Once you turn 70 and a half, you could start making QCDs. We'll talk about that at the end too. Roth IRA conversions, we get asked about these all the time. It's funny, I've kind of gotten a kick out of how many young people are all excited about Roths, and apparently it's kind of all the rage on TikTok is people talking about Roth IRAs, and I have all these young 20-somethings wanting Roth IRAs or running to convert, and it's the conversion option is rarely a good strategy. Occasionally, if we have a situation where it works, if you're going to be in a low tax bracket one year, you could convert a regular IRA to a Roth IRA so that future distributions will be tax-free, but you're paying tax up front. And that's usually something you really want to think hard about, whether that makes sense, whether rules are going to change in the future, et cetera. Again, sometimes it makes sense. That's something we would routinely be looking at for our clients every year, whether it makes sense to consider a Roth conversion. So investments. So just say no to annuities. I mean, hopefully you've kind of gotten that message from some other sessions here. I can't say this strongly enough. If there's just one thing that will save you so much grief, is do not get into that annuity. Again, these are hard sold. They're high commission from typically 7% of your investment up to, I mean, there were annuities that had a 35% front-end commission. You were basically locked into those forever and couldn't get out. They're very tax inefficient. There's no easy way to get your money out. It's always ordinary income. There's no long-term capital gains in annuities. There's no step up in basis at death. They're just no true fee-only fiduciary advisor is going to be recommending regular annuities. And I will say,
Thank you.
there's two exceptions, and one is an immediate annuity, which is not what these people are out selling at seminars, because there's not a big commission in the immediate annuities. Immediate annuity is where you now are wanting to buy an income stream. So maybe you've retired and you want to have, you didn't have a pension plan and you want to have your own annuity. You give the insurance company the money and they'll pay you a lifetime income, but your money's gone. You can't get it back. You've basically annuitized it. So you could buy those annuities, and that's a feature that all the annuity investments have. If you invest in any kind of these RILAs or index annuities or any kind of variable annuity, at some point you could say, okay, now I want to stop accumulating and I want to turn this into a lifetime income. But nobody does that. It's kind of it's a hollow promise that's because you could do that, but nobody does. Usually people are trying to get out of them and they don't want to turn it into that income stream because they don't want to lose their principal.
Don, could you possibly pull up another article that
No,
talks?
first of all, I want to counter
So
slightly to,
the charitable gift annuity
thank you.
is the other completely different thing. Really, I wish they could have a different name. Charitable gift annuities are not at all like a commercial annuity. You're basically giving the money to the charity and getting a lifetime income back from the sponsoring charity. And so the charity is benefiting instead of the insurance company.
Yes.
Charitable gift annuities can be a great way to do charitable gifting where you're also getting something in return.
Don, could you bring up that article on annuities?
If
I'd
Laura
love.
would stop sharing.
Okay, sorry to do that to you, Laura. I think this is another just a recent article that was in Investment News, and financial advice cockroaches have plenty of life selling insurance. Uh, what if you scroll down a little bit down, but Laura, talk a little bit about what does that headline tell you?
I
What's
just
the,
have to say one thing. Actually, looking at the picture again, I think that's a cricket, not a cockroach.
well,
Cockroaches are those ugly black things.
don't.
Crickets are good luck, but anyway, yes, right. Cricket.
What is
So
that? What's the essence of the article?
yeah, this article is basically saying that people who get booted out of some of the brokerage firms, and a lot of times it's not the big, it's could be the big brokerage firms you've heard about. It could also be other one of these independent firms like LPL and Cetera and Commonwealth and some of those firms. If they could get booted out of those firms, you have to have done some pretty bad stuff usually and lost people a lot of money.
Hmm.
But then they can go back, they can keep their insurance license, and then they go big into selling annuities and life
Yeah.
insurance.
Just the one paragraph. The report counts 127,865 quote unquote financial advisors who left FINRA and broke a check database over 10 years. 65,000 plus remaining are insurance producers or salespeople. Of those, close to 10 points have histories of serious misconduct, or 5 times the percentage who work as SEC registered investment advisors who dropped their FINRA licenses. It's it's a it's a it's a sales world, and there's these commissions are so high that they're like cockroaches. You can't get rid of these people.
Yeah.
And they're very, very good. They come across like they're Mother Teresa. They will do you favors. They will be part of your church. They're not creepy people. They come across very well. They're very sophisticated.
Yeah, so,
And
so it's
that's,
kind of a loophole, the insurance thing, as you said. Like you could say, I mean, I've seen some of these people calling themselves fiduciaries, but the problem is they're not regulated anymore, these people in this article, by FINRA or the SEC, and they're regulated by state insurance commissioners. So there isn't a federal regulation of insurance people. It's all state by state. And some states, and they're all different. And they're
right.
all, and none of them, I think they're really in the industry's back pocket, most of the insurance commissioners. And you don't see a lot of cracking down among the insurance
Go
commissioners.
to the next page, Don. Who buys annuities? Laura, I mean, typically people who are older, who have
People who are
cash.
older, who can't afford to make a bad investment,
Yeah.
typically.
Yeah, and by the way, this last quarter, last 3 quarters have been the highest annuity sales in history. Over $10 billion worth of new policies have been sold just in the last year.
Yep.
So
And
this
they
is
they
not a
use fear. They use fear to sell to you. They talk about guarantees and floor returns, and it isn't what they say. And I in the past I've done a lot of expert witness work against some of the big insurance companies, really digging into the marketing materials and how they talk about things. It's just so misleading.
Yeah, and this is by the way, this is the investment news. This is a industry publication that
Right.
usually is very favorable to the industry. And look at what they said. Bad brokers can be identified and love to sell insurance. The state insurance commissioners need a better brand of bug spray and use it on cockroaches. I love that line because it's so true. You,
Yeah.
sometimes you think they're everywhere. There are good brokers.
Yeah.
I don't want to make it sound like
And
they're,
they're
but
good insurance people.
yeah, it's just
Who
hard
are
to identify.
very transparent about how it works, what they're getting paid. I mean, there aren't, we haven't found a lot of them, but we found a few of them because you need insurance. Most
Yeah.
people at some point in their life need life insurance. And so, there are good people, but ideally, you should get some objective independent help to figure out what you need and then go shopping for it, but that never happens that way. You're
Look,
sold. Somebody reached out, sat down at your dining room table and sold some things.
Laura, I just want you to know one of the attendees had said that cockroaches in Hawaii definitely look like the one that
Okay, all
photographed.
right, okay.
And they fly.
I'm glad I don't really know that much about them, so they must not be around my life.
Okay, Don, let's go ahead and stop sharing, and Laura will bring back up her outline.
So anyway, yes, just say no, no free dinners, no sending your money to the guy you heard on the radio.
No indexed annuities.
No annuities. Only get charitable gift annuities and maybe, later in life, an immediate annuity. Probably not, but so investments. I'm sharing this story. Somebody at a retirement community that I spoke at a while back. It's just a woman just said, "What should I do about cryptocurrencies?" It's like, you don't have to do anything. You don't have to do anything. Ignore them. It's like you don't have to make these decisions. You don't have to. If somebody's pushing you to buy anything, you don't have to do anything. But very few people should be investing in crypto. It's a speculative asset. Yes, maybe you can make a lot of money. Yes, maybe a lot of it's going to come crashing down. There's a lot of fraud. There's a lot of black market activity being funded. There are easier, safer ways to buy it. We don't ever recommend them. We have people, our clients, usually our clients' kids, asking for them, and we have ways to help them get it. We feel is a little safer, but it's not really part of kind of core mainstream investing. Insurance products masquerading as investments, that would be any kind of annuities. There are other things. Some of the structured products are the worst that the brokerage firms do, where they can build a custom product that will protect you X on the downside and give you X amount on the upside. And it's a hedging strategy that they put together, these special notes, and they're very expensive. You cannot get out of them. We've got 2 or 3 clients that we've had that were working out of these products. One is like 15 years on that we're still trying to work out some of the structured products. It doesn't do what you think it does. Yes, you may have some protection on the downside, but you're giving up you're giving up the return on the upside. It's just something that's sold by the brokerage industry that is usually not a good fit. Once in a while, if you have concentrated stock positions, there's certain ways that these products could make sense for you, but just as a general investment for most people, not necessary. Gold and other precious metals, if people want to hold some of that in a as an asset, that's fine, but that is something that we don't consider part of a core portfolio. It's an asset that doesn't produce any income or anything. And it's had a nice little run here, but it hasn't typically performed the way it should in bad markets. And it's another speculative investment. And some people really have fun playing with their money and don't mind losing, winning, and it's a game. Mostly male, I will say. Some of the stats show that a lot of these products are more desired and invested in by men than women, who tend to be a little more conservative on the investments. But it's okay to hold some of that, but again, not something we recommend. Private limited partnerships, private placements, all those types of funds. You can get into almost any investment strategy you want in a liquid form these days. You don't need to tie up your money in private deals. In some cases, it could make sense if you have a lot of assets. But it's really, the jury is out how much you're really going to gain by locking up your money in some of these private placement investments. Pete?
Speaking of private, yeah, speaking of private placements, New York Times this last Sunday had an excellent article on private equity and that how there's private equity firms are putting together um, doctors, poor medical, unpaid medical bills, veterinarians, even financial planning firms, and bundling these up and selling them to as private limited partnerships to individuals. What's your comment on
Yeah,
that?
just there's so much money in private equity that they're desperately looking for things to buy, and including all, plumbing businesses, veterinary businesses, businesses like ours, especially businesses like ours. And private equity does ruin everything. It ruins a good business because the goal is to just strip it out, clean it up, make it look better, and sell it to the next.
Put some lipstick on it and then sell it to the fire.
Yep.
It's happening to assisted care facilities.
Yeah.
Private equity firms are purchasing these and doubling the cost, and the poor employees are even getting paid less, and the
Yep.
individuals who run them are no longer there. And
Right.
the whole purpose is to resell. So
Yep.
be
Yep. And
careful.
that's a big, I mean, it's something I think about a lot, and I all kinds of businesses, I'm asking more and more, like, who owns you and what's happening. I've really seen it taking a toll on our business where a lot of my peers have sold out to private equity firms. They offer a lot more money than a lot of other buyers, and it's a great way for the owners, founders to cash in. But the services are cut, employees are let go.
Yeah,
They
veterinarians and
Yeah,
the like.
the vet.
John,
I'm going to move us off of private investment for a moment and ask you a question that came in a Q&A that I have no idea the answer to. Are Treasury inflation protected securities, TIPS, a good investment in wildly uncertain times like now?
We never invest in tips. Basically a type of, because inflation isn't a huge problem right now, actually. I mean, it's a little bit, but it's not something that we think is should be a huge focus right now. And any type of bond is not going to do as well in an environment where interest rates are sorry, take that back. It's a It could be part of your bond allocation. It's just not something that we recommend. I think there's just so many other things going on with tips. And if you really think inflation is going to be a problem, then that could be where you allocate some money.
Okay. Now I'll let you go back. Thank you.
Individual stocks, again, for fun, but not a way to invest for most people. It's just very few people are good at building a portfolio of individual stocks that's going to outperform any market index. Very few professionals have been able to do this over time. And different people do it at different times, but we think it makes a lot more sense to buy the market and get the market returns. The stock market returns 10 to 12% annual through any market environment we've had. And I think for most people, that's a pretty good return, and you don't need to take a lot of extra risk by investing in individual stocks. If you want to own a few for fun, and I think that's fine. I mean, many of our clients do that, but we don't think that you should be trying to pick which stocks are going to outperform. We believe in it following an asset allocation process. So first you're going to figure out how much in stocks, how much in bonds, and then you're going to slice it down a little more granularly, and then just rebalance that. So this is a very big picture overview of how we look at portfolios in general. I think this is a common way of classifying different risk tolerances in a portfolio model. And this is, I think, how, like Vanguard, they have funds that are stable, conservative growth, moderate growth. So I think they're almost a generic industry terminology at this point, but they would still be different a little bit firm to firm. So we always look at moderate growth as kind of our all-weather portfolio, 60-40, 40% bonds, 60% stocks. There's often, you'll see headline news articles about the 60-40 model is dead. And that's very much not true. That's a model that's performed very well over time. You get a good deal of the upside, but you're protected on the downside for client. And so that's kind of where we would start, not knowing anything else about somebody. If depending on your asset level, whether you have more than you need or not, maybe you could afford to take less risk and you would want to be conservative growth, or maybe you're just very skittish about market volatility and you're going to feel more comfortable in conservative growth. Stable is something that clients typically have to kind of beg us for. They have to make a case for why they can't take more risk. Putting 80% of your portfolio in bonds is going to be a very hard portfolio to keep up with inflation. And there, if you have unlimited money and you don't need to take any risk, that could be a portfolio for you. Growth is usually for people who are still adding to their nest egg, or at least aren't in withdrawal mode. However, we do have quite a few retired clients who are in growth because they just are comfortable with the market and been investing in the market for a long time and are fine with the volatility. And then, we have some people who are all bonds and we have some people who are all stocks, like me, which we don't usually recommend for clients. But the returns on these portfolios over time, stable, 4-5% maybe over time, conservative 5-6-7, moderate 6-8, and growth more than 8% is what we would say to expect based on the last 100 years of all kinds of markets.
And this goes back to, what are your goals? What's your net worth? How much are you spending on an annual basis? What are you trying to accomplish? It doesn't come right out of the blue and you go, okay, well, let's put you in a 60-40 portfolio.
Right. And then we run the numbers around this, like, okay, you really want to be conservative. So, can you make it if you only get a 6% return over time? And we'll plug that into our spending model to see what that means. And we will often run two, and we'll say, if you invest more conservatively, you could look to spending X amount per month for your whole life. If you're willing to take a little more risk, you could spend more. And even in the growth model where 20% is in bonds, that can sustain withdrawals. And if you have a $1 million portfolio, you've got 200,000 of it in bonds, and that's a place that you could draw from when we have a challenging market, and that's a stock market.
What
And
I'm gathering, Laura, is that a good financial advisor crunches numbers,
yes,
you know?
or has the calculator or the computer crunch the numbers.
Yeah,
Yes.
that can do the number crunching.
Yes.
Because it's all about the numbers. It's and the likelihood of something happen, and probably not one strategy does. Most strategies does have a disadvantage.
Exactly. And the assumptions that you put into that mix when you're crunching the numbers, so important. And that's a good question to ask about, like what level of inflation are you using now for the long term when you're plugging in all these numbers, and what tax rates are you using? And so there's so many moving parts that it's not as intuitive as you think to do these calculations, and the tools are better and better that they have out there for that, where we can factor in each client's specific tax situation, what they have going on as far as they're selling a home, buying a home, sending a kid to college, going to have more draw this year, all the different things, and then factor in what it looks like under different portfolio models. And the returns, the way that we invest, the returns are very predictable over the long term. Amazingly so. So this would be a little more breakout of what that moderate 60-40 portfolio looks like. So we're actually so the bond portfolio is actually a little less than, it's not 40%, because we actually we don't have the this is a pie without alternatives. Alternative assets are another asset class you could consider, which could mean anything. And just to talk about that for a minute, because that's a buzzword right now, is alternatives, alts, which I said earlier, how you could get any investment strategy in a liquid form now. So there's a lot of liquid alts are a big thing. You could go into private credit through a mutual fund. Basically, you could get into commodities through a mutual fund. Those are things that could be considered alternative assets. So alternative assets would be anything that isn't a stock or a bond. And it can be good to have alternative assets in your portfolio, because ideally you're finding alternatives that are not correlated with the stock and bond market. So in a couple of years ago, when bonds were down and stocks were down a big amount, which hadn't happened in so long, our alternative sleeve of our portfolio was up, because it's a different kind of asset. So I think alternatives can be good. I think you can do without them and do just fine, but they can enhance a portfolio. I would just be careful of not investing in alts that aren't liquid. There's a big push by the industry to allow a lot of these fancier, sexier investments in retirement plans and IRAs and 401k plans. And that's probably not a good development. I think that people are going to end up with a lot more risk than they realize. And that'll be and more expense. Most of those funds tend to have higher expense ratios too. So this is a pie without the alternatives. And just an example, this is very similar to Vanguard's moderate growth portfolio, by the way. So we'll invest in funds that track the market. All of our stock funds are index funds. We're not trying to beat the market. We're trying to be sure that we get the market return. And we mitigate our risk by how much in bonds we have in the portfolio.
Who do you use as a custodian, Laura?
So we use Schwab.
And so let's say, for instance, if I wanted to go into US large cap stocks, would you recommend getting an ETF through Schwab? And would you recommend any particular ETF for a mutual index mutual fund?
Um, yeah, so we get our core US large, small, mid through exchange traded funds because they're very cheap, especially the large cap. I don't know, 4 or 5 basis points, 0.05 would be the cost of
Dramatically
that
cheap.
through the most of the ETFs are pretty good on the large cap. I think Schwab does have their own ETF.
Do you use
Sometimes
dimensional fund ETFs?
we don't use Dimensional. Dimensional is a good firm that takes an evidence-based approach to the market, buying the market itself, though they have different slants. They have usually a value slant and a smaller company slant, which can be a way to invest. We think that, those value and growth run in cycles, and we don't like being locked into one philosophy there.
Uh-huh.
Um,
And would you still recommend people going to Vanguard, even though Vanguard doesn't have really a local office? Everything has to be done online.
Yes, Vanguard is definitely one of the better options if you're doing it yourself. I think they've had such asset growth that I understand that it's hard, it's impossible to get someone on the phone, so you do need to be able to do a lot of it online. They have great products. They have a lot of great educational resources that help you figure it out. I have often, and actually we use some of their lifestyle growth portfolios for a smaller account. Instead of buying 8, 10 different funds, we may say go into the Vanguard moderate growth lifestyle portfolio or the Vanguard growth, and then they're basically buying all the pieces underneath and rebalancing it for you. I think it's a great way to go for a lot of people.
Is
And
there any other mutual funds? There's over 30,000 mutual funds out there. And I am assuming from your conversation that you're more of a passive or an index fund advisor or philosophy. Is that correct?
that's correct. I know Mark Hebner spoke last week, so yes, very much aligned with that philosophy. As I say, I've done it a lot of different ways over my career, but since the turn of the century, we were actually one of the first firms to start using the exchange traded funds that were all index funds at that point. Now you can have ETFs that aren't index funds. There's lots of variations of ETFs, but
So you need to be careful even buying ETFs today.
yes, for sure. Yeah, some that
And
can be wide
is
range
there
of costs.
Is there any other company, mutual funds or ETFs that you would recommend so that somebody can take a look at them? It's the Schwab ETFs are fairly low cost and
Yeah,
legitimate.
yeah. And I would say we kind of have a love-hate relationship with Schwab over the last 30
Yeah.
plus years, because Schwab, if we're on the institutional side and if you're working directly with a Schwab broker, you're on the retail side, and they're better than the Merrill Lynch's and the Wells Fargo's, but they also have the same conflicts. They're trying to sell you Schwab funds, which are better than some of the others and cheaper, but there's still a lot of conflict of interest, and there's a lot of incentive for them to put you in Schwab products.
Yeah.
Um,
So put a portfolio together. You can buy the bonds and the large stocks in ETFs. And then what do you recommend? Looking at it once a year, not looking at it at all? You know, uh, I think you
yeah,
more or
yeah.
less you want long term.
Yeah, the more you trade, the lower your return is going to be. I mean, there's just endless studies about that. And
So spend the time up front putting a portfolio together.
yep, exactly. I mean, the magic is in the mix, is what we always say. And we tweak this a little bit over time, not a lot. We are US biased. We have more in the US market, even though this year finally international is beating US. It's underperformed for many years now, so they're having a cycle now. But still, we see most of the future growth coming from the US markets. So yeah, this is a pretty standard portfolio. Have a good mix. Don't look at it a lot. If you're working with taxable money, not an IRA, trading is going to cost you. You're going to pay capital gains if you sell and you have a gain. So you really want to think twice about that between the cost of maybe paying a commission or a ticket charge. We think of it more as a ticket charge, like at Schwab. Most of their assets trade for no ticket charge. Some of them may have a $18, $20 ticket charge. But there's more charges when you're trading, and then the tax cost is big. So you're better off if there's a big move in the market. That's when you want to rebalance, and you're working counterintuitively. So when something goes up, you sell it. You don't buy more. Which is what people want to buy something when it's going up. Gold is up so much this year. Let's buy gold. And we had somebody buy some right before it went down however much in a day last week.
Laura, there's a question.
Yep.
A comment on indexing. What are your thoughts on indexing ETFs, e.g. S&P 500 market cap versus equal weighting ETF?
That's a great question. So S&P 500 or equal weighted ETF, there's a lot of people kind of pushing that idea of equal weighting the companies. We are full, and that could be a way to go. That could make some sense. There's some studies that show that could be a good way to have a better return in some environments. But we want to own the market. And part of that is because that's the benchmark everybody's using is the S&P 500, and we don't want to be too out of whack with that. We don't usually take a lot of factor tilts where you could overweight, small or value. I think we do make a few exceptions, like we may have a profitability growth tilt. But that equal weighting is just too much of a tilt that's not in sync with what the benchmark of the market is. And we like being able to tell our clients, you don't have to buy Apple, Nvidia, Amazon, because you own a huge chunk of it if you own the S&P 500. So we're going to get the upside of those assets.
Let's go to the next slide.
So the other question we're getting a lot these days as the market hits new highs, like, of course, it's a bad time to invest. And when the market hits a high, it's way more likely to keep going up than it is to go down historically. But just lots of people comparing to, the AI bubble, is it like the tech bubble in the late 90s? And this shows how what the PE ratio was of the tech companies versus where we are now with the big tech companies. So yes, the valuations are a bit high today, but they're nowhere near what they were at the dot-com bubble. So there's, from that standpoint, there's room to run for sure. So we're actually, and we also been telling clients, because people are very worried about a lot of the things going on in the world, and the market doesn't have morals, or the market is amoral, and the market doesn't care. The market is based on a lot of other things, and no matter what's going on politically, a lot of actually what's going on is helpful to the market. So you might not feel good about things, but the market is probably a pretty good place to be right now. So this sustainable spending analysis, this is crunching the numbers. This is like a capital needs analysis, a retirement analysis. But we want to, most of our clients, by the time they come to us, they kind of have their nest egg, they've made it. And then the question is, how much can I spend for the rest of my life? And we factor in all these different things, very customized to see, and we have a baseline. And then we adjust it as life goes on, because it's all based on the assumptions, whether you assume 3% inflation or 4% inflation has a huge impact. What kind of rate of returns you build in has a big impact. And then, of course, the tax situation. So when we have a huge tax act change, we want to rerun all these numbers because we've got different tax brackets that we're looking at longer term. And, you know, just a general rule, there's always a lot of planning done about, oh, you know, you'll be in a lower tax bracket when you retire and you stop working. And we always say, if we're doing our job, you won't be in a lower tax bracket. So that's not necessarily true. So you want to be careful how you factor that into your planning. Some people will be, some won't. I mean, it's very different if we're running these numbers with somebody who has has 5 million of their assets all in IRA accounts, all in retirement plans, versus somebody who has 5 million outside of retirement plans. I mean, if your money is all in retirement plans, you're going to, you know, take a, you know, 40+% haircut because the taxes haven't been paid yet. So big difference of how you treat those assets. Estate planning, you have the whole It's Your Estate series coming up sometime.
We are just finishing up tomorrow.
Okay, so spring will be the next It's Your Estate
Correct.
series, and you'll get to delve into a lot of these topics more deeply. And I would just say, you know, in general, for so many people put this off, and lots of reasons. It's the decisions you have to make going through the estate planning process are not always easy. But
just so you know, Laura, we got about 10 minutes left.
okay.
So, and procrastination is literally the number one reason why people don't have estate plans.
But I was going to say, most all of what you're going to do in the estate planning process is something you can change. So just do it, and you could change it next year if your situation changes.
Good point.
There's very few irrevocable things that you put in place. So just the basics, you don't want to put that off. Yeah, that I will leave that. The exemption's going to 15 million next year, so that's going to make a lot of advanced planning for most people a moot point. There's never been a time that the rates or the amounts have come down historically, so we don't see that changing. There's a cost of living rider that's just going to go up. It benefits people on all sides or on all parts of the political spectrum. There's just not a lot of appetite, I think, for reducing this in the future. We're pretty confident that that's going to stay. So 19,000 is the annual gift exemption amount. You can give that to as many people as you want. If you're married, you can give 38,000 to as many people as you want every year and not have to file a gift tax return. Charitable gift planning, lots of cool things you can do here. When you're giving to charity, as I said, you know, if you have appreciated stocks, appreciated ETFs, that's a great asset to give. Most charities are equipped to handle that. But a good number of our clients have donor advised funds. It's a great vehicle where you can contribute these appreciated securities in a year where you want the tax deduction, keep it in the fund, and then dole it out in grants when you want. You can set up a DAF at Schwab for as little as $5,000, go online, give gifts, I think, as small as $100. They're great tools. You can pass them on to your kids to manage after you're gone. Very cool. Qualified charitable distributions at 108,000 per year. Once you're age 70 and a half, you can give directly to the charities and not pay the taxes on your IRA. You can split this up to as many charities as you want. Giving bequests at death, and there are many advanced planning strategies, and we all have contacts who can help you look at some of the options there if you're planning some major charitable gifting. Kind of wrapping up with 10 general recommendations for financial success. Work only with fiduciary advisors. I mean, we can't say that enough. It's hard to figure out who they are. So you could ask Pete or Don or me, and we can tell you, you know, if you're looking at someone, whether they are or aren't. Focus on asset allocation, not stock picking. We believe in indexing for most people is a great way to go. The market gives you good returns. Just get them as cheaply and tax efficiently as possible. Don't time the market. I feel really optimistic about the market right now because we've had a handful of people thinking it's time to get out, which is when the general population is thinking that's usually a good time to buy. I mean, it's really amazing how directly correlated that has been over the 40 plus years I've been doing this. There's always volatility in any given year in the market. There's a down draw of like a pretty big amount, sometimes 20% or more. And then, in most years, the market ends up, I think it's six out of 7 years, the market's up historically. Invest tax efficiently, put your more tax producing assets in your IRA, like if you are in bond funds or some of the alternatives that produce ordinary income, put those in your IRA, put the other stuff in your taxable accounts. If you're still working, maximize any contribution, tax deductible retirement contributions that you can. Don't buy annuities, don't borrow to spend. Sometimes it's okay to borrow to invest, like a house and get a mortgage, but borrowing to spend like on a credit card, never a good idea. You should pay those off every month. Save for college in a 529 plan. It's still the best vehicle. Keeps getting actually more and more flexible. You don't have to go use the state that you live in. California, we don't get a tax deduction, so we think there are better 529 plans than the California Scholarship, better options and cheaper. Have a will or trust and keep it current, and don't worry about the wrong risks. Don't worry that you're missing out on some hot investment tip or something that you should be investing in. It's not that, doesn't need to be that tricky or that complicated. Keep it simple. Make sure you understand what you're investing in and the philosophy of any advisor that you're working with. And that's it. Thank you, everybody, for being here, and thank you to our charitable sponsors.
Yeah.
And a couple minutes.
Go one more slide.
Oh, yeah, about me.
Because it has your email address on it.
Okay,
which is why I wanted to be here.
Thank you. Laura at tarbox.com.
And if she goes one more page, you find out about her firm. There you go.
Yeah.
All righty. Let's go ahead and stop sharing. And one of the last questions was about a charitable gift annuity, and my answer was that you need to run the numbers. And I wanted to talk a little bit about Don. Don is our philanthropic advisor on our Financial and Estate Literacy Board of Directors, and he will be happy to run a gift illustration for you if you're considering a charitable gift annuity. And because we are sponsored by charities, I want to just talk a little bit about it because one of the most overlooked areas is a charitable gift annuity from your IRA account if you're over 70 and a half. And they limit you to $54,000 in any one year, and that is adjusted every year depending on the inflation and cost of living increases. But it's a 2-page document, and it's based on the gift annuity rates. And so if you want to see what that rate looks like for you, Don will be happy to send you a gift illustration or give you the amount that you would receive for the rest of your life. Don, do you want to give them your email address, or you want to put that in chat, and so that if anyone wants that kind of illustration, they can contact you? There is no cost or obligation for that, and Don is totally charitable agnostic. How's that? Did I say it correctly?
Yes, you did, but I'm trying to type.
Okay. So if anybody wants to ask a question verbally, there's on the bottom of your screen, you can raise your hand and or you could.
You want me to pay attention to that? You want me to type?
No, I don't want you to
Can we
pay
shrink the
attention.
size of our email address?
I'm sorry?
Can we shrink the length of our email addresses?
I know we should. I
Yes, you
think we should
should,
make
because
it
it takes
to
me way too long to type that.
iyme.org.
Incidentally, I want to go back to a chat that I sent out a few minutes ago. Last week when we were doing It's Your Money, Mark Hebner was presenting and said he had written a book, and you can go to Amazon and buy, or you can send an email to Neil, and Neil will send you a copy of it. And some of you gave us the names, your names, instead of sending them to Neil. So that chat I sent a few moments ago in terms of if you want Mark's book, and that it was about investing, then that's that you want to send it to Neil at ifa.com. And so that's why I put that one in just so that people knew that's where it is, because we didn't, for some reason, didn't get to capture all of the names of people who had sent in. What do you want me to do now, Pete?
And Denise just put the email address for everybody on the Q&A. I hope
Oh,
everybody can see that. And
On the
thank you,
there you
cat
go.
Denise. Yeah.
Yes. Yeah, put it in chat.
chat. Yeah.
Also,
Can you put
just so
that
it's
in?
everywhere.
Copy, put it in chat, paste to everyone. Okay. We both did it. Okay, there's a question. Since a 401k and a traditional IRA would effectively be a 40% taxes, and I guess she's talking about a withdrawal. What are some tips for reducing the potential 40% in taxes? First of all, if you roll over your 401k to a regular IRA, is there any tax issues involved?
Not it. No.
So
Sorry, say that
only
As
if,
long
again,
as it's in
Pete.
IRA wrapper.
correct. What's that, Don?
Laura, what did you just say? There's no tax to roll over
If you roll over an IRA, your 401k into an IRA.
an
There's
IRA. I'm sorry, I was thinking of Roth. I go, woo!
Yeah.
Yeah.
No,
So
there isn't.
so
And
so
Right.
yeah, I
then
mean,
the question becomes, if you pull out money from your IRA account, yes, that's when you're going to have to pay the taxes.
yeah,
Yes.
and
So
there's really no way to get it out to spend it without paying taxes. You can give it away. You can do a qualified charitable distribution. But if you want to take it out and spend it, there's no way around the tax. But you can plan how much you take out each year depending on what else is going on in your portfolio or your financial life. So maybe you can take some out at a lower bracket in certain years.
the in the New York Times, there was an advertisement by a financial planning firm, and they put that question. We have the secret as to how to pull out monies from your IRA without having to pay a tax. And what they were actually talking about was a charitable remainder trust and a charitable gift annuity. If you transfer monies out and to either one of those two vehicles, you're limited to the amount that you can take out, but you're making an irrevocable gift to the charity and taking income for life for your own personal life.
And you can
That's
only do it once.
but that's the only way that we have come up with to, how to take money out of an IRA and not have to pay taxes on it
While you're alive.
while you're alive. You
Right.
never, the person that
Death
you
or
give,
taxes? What?
yeah, the person that you gift your IRA account to
Will get
uh,
taxed.
will have to pay the tax. Do you find, Laura, in with your clients that the beneficiaries of the 401k of the IRAs that they methodically take it out over the 10 years that they're allowed to take it out, or do you see
Yeah, that
them?
we usually spread it out. Yep.
And what is the strategy there?
We'll just see if you're inheriting an IRA from anyone other than your spouse, you have to pull the money out within 10 years, and you don't have to do it in equal installments. But usually, we're for income cash flow purposes and then tax bracket spreading it out. It usually makes sense to just take it each year.
So you're really busy in the month of November and December.
Yeah, we've got different reasons for different seasons that we're busy. Yes, yes. And
Yeah, because
actually,
you're
what we also do, a lot of families, everybody's home for Thanksgiving or Christmas, so we end up doing a lot of family meetings with the multi-generations too, where we're talking about the trust planning and what the
gifting.
gifting. Yep,
Yeah. And then tax loss harvesting is
yep.
now, is to,
Tax loss harvesting season. Yep,
yes,
and
Okay,
yes.
since
yeah,
it is
we're over.
11:32 at the
Yeah.
moment, I'm going to say thank you very much, Laura. Thank you very much, Pete. This has been Financial and Estate Literacy. It's Your Money, part two of financial planning. And I thank you all very much. This is our sixth one. I'm going to turn off the recording and we can chat a little bit more if we wish.